Hello, everybody, and welcome. I'm Toby Gennaro, and I will be your presenter for today. The topic for today will be on trading opportunities using call spreads. So I'm going to be talking about just some unique opportunities around spreads in terms of finding some opportunities within the live screens and live trading, and we'll take a look at some of these contracts and see how they move and how they work. And call spreads, there's a great product from Nadex to supplement your trading, so I think you'll find this to be a very intriguing session as kind of walk you through what these call spreads are all about and give you some of the basics. If you have any questions while you're on the session, just feel free to utilize the question box on your screen, and I'll probably be asking you guys some questions as well, and we'll try to keep it interactive, okay? Just by way of formality, you need to put up the risk warning and disclaimer. I'll leave this up for about 30 seconds or so. If you guys could just have a quick read through, that would be good. In brief, what we're saying here is that we provide education only, which means we do not give any financial advice. And as many of you know, trading the markets can be risky. It's not suitable for everyone, and you should seek independent professional advice. All right, everybody good? And just one more disclaimer here from Nadex. If you can have a quick read through this one, it's a short one, and that'll wrap it up for the disclaimers, and we'll jump into getting the session started for you. Okay, so if you're done with that, let's kick things off here. Now, since this webinar is brought to you by Nadex and Trade with Precision, just want to take a couple of minutes here, introduce both companies so you folks understand. Nadex is actually a derivatives exchange. They are subject to regulatory oversight by the CFTC, so this is a regulated industry for your protection. Nadex is a relatively newly formed entity as of 2007, but part of a much larger derivatives organization known as the IG Group. Nadex operations right here out of Chicago, which is the hub of the futures and options markets. All contracts that we'll be talking about today are cash settled, so no risk of having a mountain of corn delivered to your front yard, anything like that. There are over 25 global markets that you can trade with 2 unique contracts, binary options and call spreads. And today's webinar will be focused on trading around these call spreads. Trade with Precision was created back in 2006 by a gentleman by the name of Nick McDonald as a provider of trading education for retail traders. So we are an international team of traders that provide training for some major brands of exchanges and brokers around the globe, and we teamed up with Nadex early back in, I believe it was 2011, to bring you folks some very specialized education around their products. So Trade with Precision is a company that's run by traders for traders, and we are specialists in trading strategy education. And so all the devices here are covered related to the platform. So whether you're on iPhone or Android, you can see all of your trades. You can see the screens, just like the screenshot that you see here. You can gain fast, secure access that's very flexible to both binary options as well as call spreads. You'll have all the popular markets in real time. Customizable charts, you have multiple time frames and indicators that you can work with, and you can view your open positions and whatever working orders and account balances that you might have in process. So got all the devices covered there, which is great. You can track your trades while you're on the move. For today's agenda, we'll be talking through, again, call spreads to help you guys gain an understanding of what they are, why you may want to trade them, and I'll talk to some pricing and contract selection examples to help you guys understand the concepts of how they ebb and flow. And then we'll look at some actual trading examples and some charts, and then I'll wrap up and give you guys some information on how to get started or expand what you're already doing with your Nadex account and with the Nadex platform. So let's go ahead, we'll jump in right here and get an overview of these call spread contracts and help you understand what they're all about if you're unfamiliar. So the question here that we're trying to answer is, what exactly are call spreads? And you can kind of think of it this way. A call spread is a standard options trading strategy that is prepackaged into a single contract. That's probably the easiest definition I can give you. Each contract consists of a floor and a ceiling price, which is known as the spread. The floor and the ceiling price represent the maximum upside and downside of a call spread contract. So you can create long or short positions based on the underlying market by either buying or selling this type of a contract. So by definition, a call spread is similar to a vertical spread, where two options contracts with identical expiration times but different strike prices are simultaneously bought and sold to produce then a call spread. Okay, so this strategy produces some different behavior characteristics than what you might experience with binary options with respect to things like time value and the underlying price. So these will look a little bit different, but call spreads, I think, will give you a sense of more familiarity because the pricing is very similar to the underlying asset pricing. So let's go ahead and talk about some of the differences between call spreads and binary options. One of the major differences between these two contracts is certainly the payout model. Okay, so call spreads have a variable payout structure, while binaries are an all or nothing proposition at expiration. There is one similarity here between call spreads and binaries. Both of these contracts are similar in the fact that profits and losses are capped at predetermined levels. Call spreads will have a floor and a ceiling level that accomplishes basically the same thing. And then binary options have predetermined levels at 0 and 100. So it looks a little bit different with each contract, but the result is essentially the same. Another unique difference between these contracts is the relationship to underlying market price. The price of a bull spread is very closely related to the underlying market price of the asset, where binary pricing is more loosely coupled to both market price and time, right? So binaries trade between 0 and 100. Call spreads trade at or near what the underlying asset price actually is. Okay, so call spreads are going to look a little bit more of the same as the underlying asset, and binaries are going to have a totally different pricing scenario between 0 and 100, if that makes sense to you. Next up, time decay, very different as well between these two contracts. You'll notice that time decay is a less significant factor for call spreads due to the variable payout scenario. There are some exceptions here. We'll talk about that a little later, but for anyone who trades binary options, you know very well that time decay does play a major part in determining that all or nothing payout. And then the last major difference is price volatility near expiration. For call spreads, price volatility near expiration never going to be higher than volatility of the underlying market that it represents. Whereas pricing for binaries can be, highly volatile in certain situations, especially when they're near expiration and the underlying market price is very near to the strike price. Okay, so those are just kind of an overview of some of the differences and or commonalities between the two. Just a few comments here on the call spread. We're looking here at a Wall Street 30 contract. So the spread range, as you can see here, is similar to the pricing of the mini Dow futures contract or the YM symbol. As you see by the order ticket here, the market floor and the ceiling are clearly identified, okay, as well as your maximum profit and loss calculation. So based on this contract structure, call spreads will trade at various prices between the floor and ceiling prior to expiration. Okay, however, the contract value of these call spreads is never going to exceed the floor or the ceiling price, regardless of the movement in the underlying market. So you can see the limited risk characteristics that are inherent in these contracts just based on that. Very similar to binary options, kind of do the same thing, just a little differently. Binaries would have a floor and a ceiling of 0 and 100, whereas these call spreads, the floor and ceiling is more representative of the underlying market price, as you see here. Using that same example of the Wall Street 30 contract that we just looked at, we'll look at a pricing scenario here just to kind of give you an idea of how the contract values kind of move and change and ebb and flow. So when the underlying market is trading outside of the spread range, okay, the contract will be valued close to or around its floor or ceiling price. So you have to account for some time value in there, just depending upon the time left until expiration. This is also known as an out-of-the-money contract, okay, which simply means that the underlying market price is outside of the spread range, which here is indicated by these red arrows. Okay, so the price is either above or below, but it's not within the range of 12,400 to 12,800. Another item to note when pricing these contracts, the call spread price will move very little until the underlying market is actually trading within the spread range. Okay. However, when the spread range, within the spread range, the time remaining, the Nadex pricing and the underlying pricing tend to have a very high correlation when the underlying is trading more in the middle of the spread. It'll just have less correlation as the underlying is trading closer to either the ceiling price or the floor price. So, a lot of times we're trying to buy these. If we're going long, we want to get these around, 12,400 when the market price is at that level, because that's when they're really going to start to move. To buy them, out of the money doesn't really pay off a lot. Okay. And the same thing when price hits 12,800, depending on how much time value is left, more than likely that's going to be, the most value that the contract will get to as it continues to move above 12,800, 12,900, 13,000. You're not going to see a large change in the contract price. Okay, so all the action again between the floor and that ceiling price. This is just a simple example of going short the Wall Street 30 call spread to help you guys understand the risk-reward profile depending upon where you make your entry within that spread or within that floor-ceiling range. Now, for example, if you decided to short the market here at, say, 12,700, your max profit would be $300 with a total risk of $100, or in other words, a 3-to-1 reward to risk, which is very, very good. We always want to have a reward to risk that's greater than or equal to 1-to-1. So, 1-to-1, 2-to-1, 3-to-1, where we're risking $1 to make at least $2 or $3 on that trade. On the other hand, if you wanted to sell this contract at 12,500, then your max reward would be $100 with a total loss potential of $300. So really just the opposite of the other scenario. This would be a 0.3-to-1 reward to risk, and obviously not as favorable, or doesn't even fit within our range of a 1-to-1 reward to risk scenario. You're basically risking $1 to make 30 cents. And so if you do that a lot, you're going to need an exceptionally high win rate in order to really just be break even. But if you're always trading on, $1 for $1, or $1 for $2 or $1 for $3, then you can actually, only have, a 50% win rate, but you still have the ability to be profitable in your trading. Makes sense? This is just a simple example going short with this call spread example. And just to kind of help you understand the reward to risk profile depending on where you make your entry within that spread. So this is just the opposite of of the last one. If you decided to short the market here, then that would obviously be be the scenario. And so it turns out to be the same thing. The numbers work out all to be the same. So understanding the price of the call spread contract in terms of time, value, and volatility is a bit different than binary options because of the makeup of these contracts. Call spreads do not have a significant time element, added to the value of these contracts. So when trading call spreads, you will notice the contract price tracking in line with the underlying market, provided that it's within that floor ceiling range of the call spread. Okay, so we'll take a look at two examples next to see how this works, and then we'll go through some of the exceptions to this rule. In this example right here, we're looking at, again, the Wall Street 30 contract. I've taken snapshots over several hours of trading to see how the contract price tracks in line with the underlying market price. A little bit of a complicated screenshot here, but I'll try to break it down for you. In the first price chart here at the time slot of around 12:25 p.m., you can see that the contract price is very close to the real-time market price of 12,630. Okay, so just a couple points on either side of that of the underlying market price. 2.5 hours later, at 2:50 p.m., we can see the improvement in price, even with the decay in time value. Okay, we're still tracking in line. Price is currently right around 12,693, and that's pretty close to the bid price of 12,691 and the offer price or the ask price of 12,696. We're kind of right in the middle of that. As the contract approaches expiration at the end of the day, 4:15 p.m. right here, you'll notice that the contract price really hasn't done anything unusual other than perform within the underlying market. So as long as the underlying price is within the spread range, you'll typically see this type of price action, basically point for point movement with the underlying market, which really makes the contracts more predictable as they approach expiration. So very unlike characteristics of binary options, where they can tend to really fluctuate a lot as the contract gets near expiration. But these will perform a little bit more as you would expect, depending upon the volatility of the underlying market. So it almost feels like you're trading the underlying market, but you're just doing it with a call spread. There are some exceptions to this rule. Price may not track in line with the underlying market on two specific occasions. The first is when call spreads have just opened for trading and have the majority of time value remaining. The second will be when call spreads are trading close to the floor or ceiling level with a lot of time left until expiration. So in both of these instances, be prepared to factor a premium into the price for that time advantage until expiration. Because as you know, as time passes, the call spread price will gradually move closer to the underlying market price until it's actually tracking in line with the underlying asset and the underlying market price. Okay? Now, as I discussed earlier, time decay, not really as significant here in call spreads as it is in binary contracts, but you still have a time limit risk on your trades, right? So while time decay may not be as significant, it's critically important to give the trade sufficient time to work out and to reach your price target. Okay, the opportunity cost here is that the market reaches your target, but only after expiration time, which really doesn't do you a lot of good, right? Let's see an example. Let's see some examples of some of these spreads in action and kind of show you what they look like from the platform perspective and kind of relative to the underlying price, and kind of get you familiar with with how these ebb and flow. Let me just set up my screen here. So I think you guys, let me take a look here at the audience view, make sure you guys can see everything all right. So you can see my current screen up. We're just logged into the Nadex platform. Just want to spend a couple of minutes just kind of pointing out some of these contracts. Right here, I'm currently in the US 500, which is the S&P index. And then here on these contracts, we have about a handful of them, and we have about 40 minutes left on these contracts. And we're looking at what basically the 1 p.m., the 11 a.m. to 1 p.m. contracts right here. So the indicative price, without even going to the chart, We can see the indicative price right here is at 27.41 for the S&P. Now remember, the indicative price is actually the futures price with all of the averages that are included, taking, all of the different price averaging that Nadex does to arrive at the final closing price. What they've done is they've put this basically into a chart so you don't have to worry about it. So this will differ slightly from the underlying futures price, but they're pretty close, and this is the actual price that the value of a closed contract is calculated on. So right here at 27.40, 27.41, we only have really two contracts that are going to have any trading opportunities here. This one has a ceiling of 27.40, which doesn't make any sense because there's, from a long perspective, there's no place for it to move. If you're actually looking to short, then this would be right at the ceiling, which would be an opportune time to short this contract. But we'd actually have to look at the chart to see where the trend is, if the trend is long or the trend is short, or or what's happening there. Some of these other ones at 12.35, they're completely out of range, so really nothing there. If we're going long, then we have one here that is right in the middle, which we can get some good movement all the way up to 27.45. And then we have another one here that's right at the floor of the contract, and this one gives us the full move all the way up to 27.50, so a little bit longer move than this contract here at 27.45, and the corresponding bid and offer prices will then reflect that. And then you have the offer size of how many contracts the market makers are willing to cover on each trade that you open. So these contracts are obviously fairly liquid. Let's take a look at one of the charts. And one question has come up with the indices: is it a dollar per point or a dollar per tick? And in these move differently than the binaries. So these move with specific regard to the underlying price. Okay, so as the price moves, then so will the underlying contract, based on that floor ceiling price. So as we look at this, we have a nice uptrend here. We're looking at a daily chart. And so in looking at this, we have, a nice upward trend. Looks like we have not necessarily a flat level, but we had a nice pullback into a moving average zone right here. Then we got a nice bullish candle, and then we just broke that high, and now it looks like we're moving up to another high. So another high might mean, the market's going to be at 27.50 potentially by the end of the day. There's a nice consistent price action movement here to the upside. All of the candles here are very small, which tells me that there's a lot of consistent buying pressure. We had a nice little flat level break right here, nice little flat level break right here, with all of a sudden just nice pullbacks or consolidations in and around the buy zone. That tells me that price is very predictable, and it's moving in a direction that I can forecast. So with that said, we could look at some other levels. Just by looking at this, I wouldn't even be interested in shorting anything related to the price action here. So when we go back to the price chart, really the only two contracts in play here based on the momentum and the trend are going to be the two contracts, 27.35 and the 27.40. And those are the ones where the price action is either centered in the middle of the spread or it's at the floor of the spread, which is ideal for what we want. If we take a look at something else, a little bit more of a daily opportunity, there's more time here, like almost 4 hours. So we get some different lineups here in terms of the pricing. The indicative price still the same. That's the market price. So right around 27.41. We really don't have any of these that fall within the realm, with the exception of the 27.45. But in my estimation, being 5 points out of the floor of that spread, if we're going long, doesn't really work. Doesn't really work all that well. You want to get these pretty much right around that floor price or right around the ceiling price, depending upon whether you're going long or short. And that's kind of the idea. But you still have some time in another 2 hours. I mean, we could be at the floor ceiling price there if you think the market's really going to take off. To the upside going into the close, this one gives you a little more range to the upside than the previous ones we looked at, where they capped out at 27.45 and 27.50. As you go to a longer time horizon, you tend to get a wider spread range. As you'll notice, the spread range here is between 27.10 and 27.50, so you get about a 40-point range on these. And this is one on the daily that you can actually take a look at, because the 27.41 is kind of almost right in the middle or toward the upper range, going all the way up to 27.50, and it gives you almost 4 hours to get there. So these are some nicer contracts that will give you a lot more time. You'll have to pay a little bit more for that on the bid and offer. But the other one where we only had 40 minutes and we were at the floor, that was going to be a much faster opportunity. But this one here gives you the opportunity to kind of coast for and trade the remainder of the bulk of the day based on that daily chart. Okay, so those are just some concepts of of how to trade these contracts and how they look, and whether you're going long or whether you're going short, and where to get involved on some of these contracts. We can take a look at a couple of these charts and kind of see what things look like. So as we look at this chart, we kind of missed the opportunity to trade this one long. I would have wanted to see this candle close out and then look at the next candle open and break that level, and that's where I'd want to be looking to to get long this particular scenario. So as we look through our charts, we're going to be looking for, this is called the trend flow trade. When we do the advanced course, we're teaching you guys this trade on how to read market price action and look for these pullbacks or consolidations back into the buy zone and looking for that breakout going in the direction of the longer term trend. Okay. And then let's see, what else is there? So things aren't going to look too much different. There's the Wall Street 30 contract. If we look at the indices, there's another one that has about 90 minutes on it. The indicative price on basically this is the Dow is 25,356, so a little bit below that 25,400 level. And so this one right here is pretty close. You're only about 50 points away on the Dow. That can move pretty quickly. And so that's a reasonable opportunity where you can get in going long at the floor, and then the corresponding bid and offer price with the bid and the ask. And then looking, some of these, like this one right here, would be at the top, 450. You could still catch a few other points right there, and you wouldn't be paying a lot of time value, since it is the indicative price is within the contract spread range. And then everything 25,400 and under really doesn't have a whole lot of upside, and these two are basically completely out of the money. So those are no opportunities as well. So it just depends on on what you're looking to accomplish. We always teach trading with the trend, and so that's why I'm kind of isolating some contracts that have opportunities associated with them, because we want to trade these when price action is within that spread range. And sometimes if the markets are moving really fast, then sometimes you won't have a selection on the contracts, because the price range has moved well beyond the ceiling of the high contract or well beyond the floor of the lowest contract. And so price might be somewhere way down here and doesn't give you the opportunity to have a call spread tradable within that price action on that particular day. But if you wait until this one expires or move to a different contract, like the 8 to the 415, then that'll give you some different range, both to the bottom and to the upside. That'll bring in that market pricing to help you understand and give you some contracts to trade with. So does that all make sense to you guys in terms of just kind of talking through these contracts, when to trade, when not to trade? You want to be trading these when the price action is between that floor and ceiling spread range, and that's when you're going to get price movement. Trading these outside of the range on this one, anything below 27.45 or above 27.75 is not going to make a lot of sense because the contract is just not going to move. Okay? So that is, if you guys don't have any other questions, we're pretty much at the end of the session. Normally we do some more types of trading scenarios on Tuesdays. So join us Tuesday mornings. Sometimes we're going to be doing the market movers segment where we'll actually be going in and looking for trade setups, utilizing the 2 trade strategies to find those trades. Today was a little bit different. Wanted to help you understand the actual contract and how it works. And then we'll put those into action on some other Tuesday sessions just by looking at pure trade setups and then how to trade those technical setups on the chart. So if there are no other questions, I think we'll wrap it up for right now, and have a great rest of the week trading, and we'll look forward to talking to you next time. Take care.